Good day, fellow investors. Did you ever get stuck in a stock where you would see that stock just go down, 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 and even more down? Did you ever have a stock thus that many call dead money? If yes, I want to continue with my series on the biggest investing mistakes people make, and the link to the other two videos will be in the description below. And today I want to discuss about fair value. Many think, oh, this stock has a fair value above the stock price, let's buy it, and it is undervalued, it is overvalued. And I really want to discuss the concept of fair value because I see a lot of mistakes, a lot of big mistakes there. And I received a great comment on a video where we discussed the economy, the macroeconomy, and I mentioned a stock that I was analyzing, JDE Peets, and Ravencroft there said that they bought the stock and it was only dead money. And then about fair valuation, everything, I found it as a great concept of one of the most common investing mistakes. To discuss the concepts, I'll elaborate deeper as there have been requests on Peets, JDE Peets Stock, also my analysis. I'll also include my analysis on Just Eat, Takeaway, GRUB Stock, whatever you want to call it, to really explain the relative and the absolute investing concept. If you enjoyed this, please smash that like button, and if you haven't, subscribe so that we can reach 200,000 subscribers at least by this Christmas. That would mean a lot and would support the channel and or the charitative initiatives that this channel supports. Thank you for that. So here is the comment from Ravencroft. JDE Peets been dead money for me so far. I thought coffee, so one factor focus, what could go wrong in the long term. So coffee, but it's not about the factor, it's also about the price you pay. Then looks like it was overpriced at IPO, although 20 times free cash flow would be fair, I guess. And 20 times levered free cash flows, that means assuming the market will price things differently and the stock will go up. That's a fallacy and that's a mistake when it comes to investing, assuming that the market should price something differently. And that discusses fair. Well, I've known since I was a kid that life isn't fair. If you start thinking that life isn't fair, everything becomes much easier in life. And when it comes to dead money, are you buying a stock or investing in a business? That's core to comprehend. So let's discuss JDE Peets Stock, Douwe Egberts. So this is traded on the Dutch stock exchange, and it's a company that owns 10% of the global coffee market. It was owned by a group of companies, and then they have listed it so that they can monetize on the investment. And since then, the stock has been going nothing but down. There are several reasons why the stock is going down. A, analysts expect that as coffee prices increased, that the company will not be able to transfer higher coffee prices on the customers, and therefore the margins will be smaller in 2021, 2022, and that's why the stock has been tanking. Plus, a lot of owners of the stock, maybe because of those reasons, have been really dumping the stock on the market as the stock has become public. So a lot of negative forces pushing down the stock. The result is down 40%. And if we look at valuations, the market cap, the stock is still going down as I have analyzed it last week, and valuations 2.5 billion euros, market capitalization, dividend yield 2.8%, price earnings ratio 20. But let's go to my stock market research platform. I have analyzed it there and I'll show you the analysis. Of course, you can check what I do. Here is the curriculum. I go to the covered stocks. There are latest sectors that I made: North America, Europe, and I have added JDE Peets to my covered stocks research. So just a quick deal on the business: 1 billion in free cash flows. So when we compare to the market cap, it's priced to free cash flow of 13. And if you think, okay, the market should give it a price to free cash flow to 20, it's a coffee, it's stable business, so it means it's undervalued from that perspective. Of course, analysts expect, this is Nestlé, when coffee prices go up, they dump coffee stocks like Nestlé like it has been the case in 2009, 2012, 2015, but of course Nestle did really good since then. And now the company has 10% of the coffee market. The coffee market is growing at stable rates, especially faster, for example, in China or some specific markets. It's well diversified. I got good answers when I asked you about Peets. What are the comments? It's building a niche in the States, which is positive. There are barriers to entry as it's not easy to replicate the coffee supply chain, and they expect to grow with Peets in the US, and also they are growing very fast in China. They are paying a dividend and they expect mid-single-digit growth over time. They are still small in the US, they compete with Dunkin' and Starbucks, and that has been also the key focus in your comments. But they are lowering debt, so there is value creation. They are now focused on lowering leverage, but they lowered it 1.4 billion in just a year here. That means that, okay, there is creating cash, there is creation of real value. They have refinanced their loans and they are really paying nothing for that money, so it's even not smart to pay down debt. And one day when they reach a healthy debt level, they plan to do share repurchases, and when that happens the stock should react really well. And I have made a quick valuation on my template, and if we put just the dividend, which is an absolute metric, and if the dividend grows 7% over the next 5 to 10 years, then we see that the intrinsic value for a 10% return, all else equal, dividend yield around 3%, is around 11 billion. From free cash flow perspective, I still get to 11 billion depending on the valuations here. Of course, for a huge margin of safety from an absolute perspective, if we put 7%, 6-7% dividend yield with growth ahead, then you should buy it at half the current price, but you never know. Just a note here on valuation. So here is the discount rate, which discusses the expected return, in this case 10%, and if you look for a 10% return long term, all else equal, especially this terminal multiple, this is, let's say, a good investment at current levels or close to current levels. Nothing wrong. However, if we look at the margin of safety, and here comes, okay, the absolute value. So from a relative perspective, now JDE Peets is undervalued compared to the market, to metrics, to everything. But from an absolute perspective, okay, what would it take for JDE Peets to be a stock to put into my top 5? Now it is a contender for the top 10, but to put it in the top 5, then I would have to see it at half, maybe a little bit less than half, perhaps a 20 terminal multiple, 20, that's a dividend yield of 5% plus 5% growth. That as a minimum for a margin of safety. Then whatever happens, I'm happy with 5%. I can reinvest that, I can buy more, and I have that absolute return that gives me safety when buying something. This is still 40% down from current levels, but maybe if the dividend growth is a bit faster, then perhaps it can be a little bit more, so below the 10 for sure. Then it could give me a margin of safety investment where I would, let's say, get a dividend of 5% plus 7% growth, and then I get to a return of 10-12%, which gives me a good absolute return. And then when the market turns exuberant, then you might want to sell it or compare it to other opportunities. We'll discuss more about the relative and absolute in a moment. My plan is, of course, to follow this stock over the next year. That's why I have put in on my covered stock lists. My stock market research platform members will get an email when something happens there. If I feel that it might be a Peter Lynch cyclical buy, he says that you have to buy this before things start to improve. And for now, things are still negative. analysts expect negative earnings, so it might not be the best time to buy yet, and then also compare to other opportunities. But that's why I have set it on my covered list. It's a very interesting business. However, when it comes to investing, there is always the question of fair value and absolute value. But before that, let's give another example. Let's discuss GRUB. So Just Eat Takeaway, or GRUB Stock, has been doing really well up to the end of 2020, and since then very negative. There have been some legal issues for GRUB in the States, like fee caps where they cannot charge more than 15% of the restaurant price for delivery, so that has been negatively impacted, and the market cap is 13 billion. Of course, the company is not yet profitable. I have analyzed this as it's traded both in the New York Stock Exchange and in the Netherlands and here is just below Peets Just Eat Takeaway, or GRUB, so they have merged in an all-stock acquisition, and of course, they are a marketplace for buying from restaurants, but also if the restaurant doesn't have their own food delivery, they provide the delivery. They are market leaders in North America and Europe, but there are several risks there. So that's also the core of my analysis, because when it comes to such companies, growth companies, yes, they have a leading position, but it's easy to have a leading position when you're losing money to build that leading position. And then there is always someone that can do the same and offer better terms on losing money conditions, and perhaps not get to your position, but just make you unprofitable for longer, which completely skews the investment thesis. However, I have found that Volt has been acquired by DoorDash for 7 billion, which is a valuation of 2.5 times gross transaction value. So that was at 7 billion. With gross transaction value of 30 billion, this would be valued at 75 billion. So it is undervalued, extremely undervalued. This is a 5x stocks based on those valuations. However, that is relative. Absolute investing, this stock isn't making any money, and we can't value it from that perspective. Then we can value it from a perspective, okay, what kind of return do venture capitalists expect? Around, let's say, 15 to 20%. And then you say, okay, at current levels, what should happen to the business so that I get a 20% yearly return? Which means that it has to double in the next 3.6 years and then quadruple in the next 7 years. So by the end of the century, this must be a 50 billion company. For 50 billion, they expect, if all goes well, to make 3 billion on EBITDA in 5-7 years. So that is an EBITDA of, price to EBITDA of 20 something. So that is something you can relatively value, but from an absolute investing perspective, it's too risky. I don't know whether there will be, it will happen, it won't happen. That's really venture capitalist investing. Now venture capitalist investments are all over the current market, and that's why I wanted to discuss it, which makes it very risky for retail investors. Of course, some stocks like Tesla will explode and go to moon. Sorry, Tesla is going to Mars, but that's one of a kind and doesn't make investing more profitable or not. It's simply too risky for absolute investors. So what is fair value? JDE Peets Stock, for price to free cash flow of 20, the fair value would be 20 billion compared to the market cap of 13 billion, so undervalued. With GRUB, as we said, price to gross transaction volume 2.5, or price to earnings ratio, it's very difficult to decide, and that's why you see those big declines. And here we come to relative to absolute investing. Relative is, okay, the market thinks this, should think that, and that's extremely risky because you don't have a margin of safety when it comes to your investment. An absolute way of looking at that would be simply, okay, JDE Peets 2.7% dividend yield. Am I happy with 2.7%? With the business growing 5% per year, my return long-term around 7%. Am I happy with that? If yes, then that's a great investment for you. Everything else is mumbo jumbo, everything else is too much risk. Thinking in an absolute perspective eliminates 99% of available investments out there, but makes you focus on that 1%. Oh, look, this is a good investment for me. You eliminate all those risks related to stock prices going up and down. Not that those stock prices will not go up and down. It's just that if those go lower, you simply buy more because you know what you have bought. And this is extremely important for the current market because so much is currently focused on relative valuation. So this bond is undervalued with a yield of 1% compared to others of 0.5. That's insane and that's crazy investing. And if there is one message that I can give you, it's that you should start really focusing on absolute investments, even if they are difficult to find now. That's the investing way that will save you for all the risks that will materialize sooner or later in the current market. To just dig a bit deeper here on the relative versus absolute investing. If you invest in the S&P 500, this is the current dividend yield, 1.29%. So 1.29% over the last 30-50 years, dividend growth has been 5% per year. So all else equal, where the valuation of the S&P 500 remains at the current, which means that the market is happy with the current dividend, then you will make 1.29% plus 5% per year in growth of the S&P 500. But if this changes, and this is the treasury rate for the 10-year treasury in the States. So people say, investors, pension funds, they say, okay, interest rates of treasuries are 1.5%, the US government is with a lot of debt, so I prefer to own the best businesses out there compared to treasuries. But at some point in time, for example, if treasuries go higher and there is then also a higher requirement of dividends, then if dividend growth can't keep up, then there is only down for an index fund like the S&P 500. The S&P 500 grew since 1981, and if you look at the chart of the S&P 500, it has been growing since September 1981 because interest rates went just down, down, and down. If interest rates revert, like it has been the case since 1968 when it has been significant growth, then stocks will go lower. And that's a risk of investing in things just because of their relative potential or comparative value instead of the absolute value. I prefer look at absolutes, 1.29% dividend yield. I'm absolutely not interested. Let's look for better opportunities, be it stocks, be it whatever in life. And that's the core of investing, the core investing mindset that will make you find great investments over time. If you enjoyed this mindset, please smash that like button, consider subscribing to the channel, and check what I do before the end of the year if you're interested in my research and the specific and the coverage of stocks that I do. Thanks, and I'll see you in the next video.